Treasury yields under a little bit of pressure this morning after the Federal Reserve's preferred inflation gauge coming in line with expectations. Bond yields have been on the rise this week as investors were considering the Fed's higher for longer stance, but we are seeing a dip following that PCE print. Joining us in studio to discuss, we have Kay Herr, JPMorgan's US CIO for fixed income, currencies, and commodities. Kay, thank you so much for being with us this morning. I just want to start on your reaction to some of the data that we're getting out today. It seems like we've been joking that the meat is the new beat when it comes to data. Do you think that that is going to be continuing here? What does that look like in your outlook?
I have to confess, I'm not sure what that means. The meat.
The meat, like if you
meant M-E-A-T,
I know.
so you threw me. I'm sorry.
I'm going to work on a new phrase.
No, okay.
No news, good news.
With you now.
I'm workshopping.
Okay.
I'll take your feedback after the hit. Yeah.
Okay, so look, the bond market's really focused on three things right now. Bond market's focused on inflation, which we got a read on this morning, on employment, which we're going to get a read on next week, and then the Fed's meeting on June 11th and 12th. So let's start with inflation, and you're right. It was basically a meet, and a meet is a good thing, and you mentioned that bond yields are under pressure. That's a good thing. That means prices are rising in the bond market. So yes, a number that's in line with expectations has actually been well received by the bond market and broader financial markets. So please.
I was going to say, what do you think just of the pricing action that we've seen right now in bonds and yields? When you take a look at the 10-year, you're right around 4.49. Are we going to stay in that range right around 4.5 here until we get a bit more clarity?
Yeah, I think that's right. And there are really two things we're looking for in terms of economic data. And then the third thing we're looking for is the Fed. So let's talk about all three of those things. The first is inflation. As I said, we got a good read on inflation this morning in terms of personal consumption expenditures. The reason that's so important for the markets is because it's the Fed's preferred measure of inflation. And what we've seen is a step down in inflation. So on a year-over-year basis, inflation is now running at 2.75%. The Fed's target is 2.6%. So there's been a lot of talk about inflation reaccelerating, but that's basically kind of rounding error. If you look underneath in some of the details, if you look on a 3-month annualized basis, we've gone from a 4.4% number in March down to 3.46 in April. That's a pretty meaningful step down. If you look on a month over month, in April, that was running 0.334. In March, we're running 0.249. So I think and then on an average monthly basis, in the first quarter, things were at about 0.36%. For April, 0.25. So a reasonable step down, moving in line of what the Fed thinks.
If we do see the numbers hitting that 2.6, is that enough for the Fed to cut? I know they've said very clearly that they want to get to 2% and that then everything's going to be great, whatever. But are they going to need to see a meaningful crack in something like the labor market to actually cut?
So you got to remember, the Fed's focused on two things. They've got a dual mandate, and that mandate is stability of prices and full employment. So we've just talked about inflation coming down, and remember, the cure for high inflation, for high prices is high prices. You see that in some of the economic data you saw this morning. So prices for goods were up 0.1%, but what you saw was real spending on goods declined 0.38%. So inflation is moving in the right direction. It's what the Fed wants. The other piece of it, and then if you look in even more detail, the real progress in inflation was in services ex housing. So what is that? That's healthcare, that's recreation, that's transportation, so airline prices. We'd seen a lot of progress on that. In April, that was 0.26. It had been running as high as 0.44 in the months of the first quarter. So that's real progress. Why does the Fed look at that? That's correlated with wages, and that's exactly the next point. We've had a very strong labor market. We've actually had 29 consecutive months with unemployment under 4%. That's the longest string we've seen of strong employment since the 1960s, you have to go back to. So we get a read on non-farm payrolls, we get a read on non-farm payrolls next month. Consensus estimates are about 185,000 jobs. The cycle low for the unemployment rate was actually 3.4%. We're all the way back up to 3.9%. So, our expectation is that the cumulative and lagged effects of Fed policy are starting to take a bite. We're going to start to see a little bit of softness in the labor market. And that's going to lead the Fed, to answer your question in a long-winded way, I'm sorry, but to answer your question, the Fed's going to move toward cutting rates, yes.
Okay, what do you think that softness, when you talk about a little bit more softness within the labor market, to what extent? I guess, what are you expecting to see with that weakness?
So that's a great question, and that's what the Fed's anticipating. That's why they're watching this decline or this disinflation so closely, and they're watching the labor market so closely, because what they don't want to see is a hard landing. So the Fed's actually engineered something that's extremely difficult to accomplish, a soft landing in the economy. We last had one of these like this in 95, 96, and what you saw then, the Fed was worried about inflation, the Fed was worried about the unemployment market being strong, and nevertheless, they cut in July of 1995. So we think the Fed knows that history. They want to repeat a soft landing. They don't want a hard landing. That's why we think the Fed eases.
Really quickly here, I'm curious about where you see value in the curve. If we are starting to see some disinflationary trends, does the long end of the curve start to look a little bit more attractive, or is it still front end all day?
I think it's the front end and it's the belly of the curve. We think you get some, if you look at where the yield curve is, the yield curve's disinverted. That's typically been a sign of a recession, and we haven't had a recession yet. The Fed's trying to prevent a recession. The way they do that, they cut rates. You get the long end to come down. You get the yield curve to disinvert.
Thank you so much, Kay. This was really fun. Appreciate you joining us, and we'll talk about my catchphrases in the break here. Really appreciate it. Thank you so much. That was Kay Herr. She is JPMorgan's US CIO for fixed income, currencies, and commodities.